Good morning, everyone, and welcome. I call this meeting of the NCUA Board to order. First, I'd like to recognize our guests who are with us today. I believe the NAFQ Board is here joining us. If you all could stand so we can properly acknowledge you. Good morning and welcome. Thank you. You honor us with your presence, and we also have the head of NASCA's here with us today as well. We're delighted to have you here with us. Thank you all for joining us. I really appreciate it. The first item on our agenda today is the Share Insurance Fund Quarterly Report. Staff presenting Rendell Jones, Chief Financial Officer. Good morning, Rendell.
Good morning. I'm here to present the 2019 third quarter statistics for the Share Insurance Fund. Our external auditors have completed the financial audit of NCUA's schedule of other assets and contributed capital for the quarter ended September 30th, 2019. Because the federal government reports on a fiscal year that ends September 30th, the U.S. Department of the Treasury requires calendar year reporting agencies like NCUA to obtain audit assurances over the financial statement line items or note disclosures that are identified as material to the financial report of the U.S. government. The schedule received an unmodified or clean opinion with no reportable conditions. Slide 2, revenues and expenses for the quarter. This table shows the Share Insurance Fund's revenues and expenses for the third quarter ended September 30th, 2019. For the quarter, the fund recorded net income of $24 million. Total income of $80.1 million consists primarily of investment income from Treasury securities of $76.9 million. Additional income sources include $3.2 million collected for guarantee fees on the NCUA guaranteed notes or NGNs. Operating expenses were $48.2 million for the quarter. The provision for insurance losses increased by $5.1 million during the quarter. The specific reserve increased by about $300,000 and the general reserve increased by $4.8 million. I'll discuss the change in the provision for insurance losses on slide 5. The natural person credit union asset management estate loss expense shows an increase of $22.7 million due to unfavorable changes in the estimated future cash flows of estates held by certain asset management estates. The corporate asset management estate loss expense decreased $19.9 million due to favorable changes in the estimated future cash flows of the legacy assets in the NGN program. The next table shows the Share Insurance Fund's balance sheet as of September 30th compared to the previous quarter. For the quarter ended September 30th, total assets are valued at $16.7 billion, of which 92.3% are funds held with the U.S. Treasury in cash, overnight investments, and Treasury notes. Overall, total assets increased by $618.1 million, or 3.8%, largely due to $550 million in capital deposit adjustments for credit unions with assets over $50 million. The receivable from the natural person credit union asset management estates is $342.8 million, which decreased $39.6 million, primarily due to actual collections and the decrease in the estimated value of future recoveries. The receivable for the corporate asset management estates is $316.5 million, which increased nearly $50 million from the previous quarter. The increase is due to continued improvement in estimated collection of future asset management estate recoveries. This receivable typically increases for estimated future recoveries of the legacy assets in the NGN program and decreases by cash collection for recoveries such as bond maturities, sales of assets in the asset management estates, or recoveries from litigation. Accrued interest in other assets is $77.9 million, which increased about $7 million or 10%, largely due to an increase in Treasury interest receivable. Total liabilities are $138.1 million, or 0.08 of assets. Accounts payable and other liabilities of $22.2 million increased from the prior quarter, primarily due to about $19 million capitalization deposit refunds. The Share Insurance Fund Insurance and Guarantee Program liability or reserve will be explained in the next slide. The fund's net position is comprised of capital deposits, which represents the total balance of all federally insured credit unions' 1% capitalization deposits and cumulative results of operations. Net capital deposit activity increased about $540 million this quarter. The balance of cumulative results of operations increased by $56.5 million during the quarter due to unrealized gain on investments of about $33 million and $24 million in net income for the quarter. Next on slide 4, Share Insurance Fund reserves increased in the third quarter from $111.9 million to $115.9 million. The reserve expense is $5.1 million, which is comprised of amounts from both the general and specific reserves. The general reserve increased $4.8 million for anticipated losses, and the specific reserve increased by $300,000. Each quarter, NCUA assesses specific reserve needs for credit union failures when the loss is probable and estimable. The Share Insurance Fund paid $1.1 million for the cost of liquidations during the quarter. The reserves at quarter end totaled $115.9 million, with $4.8 million for specific reserves and $111.1 million for general reserves. Next, turning to the Share Insurance Fund's portfolio. As of September 30th, the Share Insurance Fund had $15.3 billion at par value invested in Treasury securities with maturities out to August 2026. The weighted average life of securities held by the Share Insurance Fund is 2.2 years, and the weighted average yield of securities held by the Share Insurance Fund is 1.94%. Last night, we invested about $1.39 billion at a rate of 158 basis points, earning approximately $61,000. The second bar chart shows a cumulative picture of how much of the portfolio will mature over time. About 85% of the portfolio will mature over the next 5 years. During the third quarter of 2019, 4 Treasury notes matured in the amount of about $900 million. These securities had yields ranging from 1.02% to 2.66%. Turning to the equity ratio chart, the current equity ratio is 1.33%. The ratio is based on an insured share base of $1.2 trillion at June 30th, 2019. The blue line represents the normal operating level, which was 1.38% in June 2019. Consistent with our policy, the equity ratio is updated semi-annually for June and December. Next, turning to credit unions with Camel Codes 4 and 5. The total number of Camel Code 4 and 5 credit unions decreased by a net of 4 during the third quarter of 2019 for a total of 200. Of these credit unions, 89% have less than 100 million in shares. Approximately 9% have more than 100 million in shares, but less than 500 million in shares, and the remaining 2% have more than $500 million in shares. Total shares represented by credit unions that are Camel Code 4 or 5 are $10.1 billion, or 0.84% of all insured shares. There is a 2 basis point increase compared to the ratio at the end of the last quarter. Comparing Camel Code 4 and 5 from June to September 2019, there was a decrease in the number of credit unions with total assets less than $10 million. The number of credit unions in all other asset categories remain unchanged from the prior quarter. Total shares increased $300 million, or 3%, to $10.1 billion, and total assets decreased $200 million, or 1.8%, to $11.2 billion. The number of Camel Code 3 credit unions decreased by a net of 11 during the third quarter of 2019 for a total of 861. Of these credit unions, 89% have less than 100 million in shares, 10% have between 100 million and 500 million in shares, and 1% of these credit unions have more than $500 million in shares. As of September 30th, 2019, total shares in Camel Code 3 credit unions were $37.7 billion. This is a $6.3 billion, or 14.2% decrease from last quarter. Camel Code 3 credit unions represent 3.2% of total insured shares at the end of the third quarter of 2019, which decreased about 52 basis points from 3.7% at the end of last quarter. Comparing Camel Code 3 from June to September 2019, the number of credit unions with more than $10 million in total assets decreased. The number of credit unions with less than $10 million in total assets increased. Camel Code 3 total shares decreased by a net of $6.3 billion or 14%, and total assets decreased by $7 billion or 13.9%. Slide 11 shows the distribution of assets by Camel Code. The red portion of the chart is the percentage of total credit union assets that are Camel Code 4 and 5. The green represents the percentage that is in credit unions Camel Code 3, and the blue represents the percentage credit unions that are Camel Code 1 and 2. The distribution of assets over the last quarter increased 0.4% for Camel Code 1 and 2 credit unions and decreased 0.4% for Camel Code 3 credit unions. Camel Code 4 and 5 credit unions remain the same. Through the third quarter of 2019, there were 2 credit union failures that incurred losses to the Share Insurance Fund. There was 1 involuntary liquidation with a purchase and assumption agreement and 1 assisted merger. Year to date, the cost of failures in 2019 was $40.1 million. For all of 2018, there were 8 credit union failures, 6 of which were involuntary liquidations with a purchase and assumption agreement, 1 regular involuntary liquidation and 1 assisted merger. The cost of failures for 2018 was $792.5 million. At this time, fraud was a contributing factor to 1 of the 2 failures through the third quarter of 2019. This concludes my presentation. I'll be happy to answer any questions.
Great. Thank you, Rendell, for your presentation. The quarterly updates on the Share Insurance Fund continue to be a relevant and important agenda item for the NCUA board meetings. But I do have a few questions for you. As was the case for last quarter Share Insurance Fund results, your briefing highlights what looks to be continued stable economic activity reflected in the financial statements that are consistent with the Share Insurance Fund's expected performance. Is that, in fact, a fair assessment of the Share Insurance Fund's health at the end of the quarter?
Yes, it's a fair assessment. So the results of operations and the position of the Share Insurance Fund at September 30th is consistent with what we would expect.
Great, and I have a final question. I know I asked this last quarter, but it's important to note. If you could please turn to slide 6. The Share Insurance Fund equity ratio. I note that the equity ratio is at 1.33% for the quarter that ended June 30th, 2019, as compared to the fund's normal operating level of 1.38%. Is the reduced equity ratio for June unusual?
It's not unusual because the June equity ratio is based on insured shares at June. However, we don't invoice for adjustments to insured shares until September. So in accounting rules, you wouldn't recognize that until later. And so because we update it twice a year, it's not unusual or a cause for concern based on the performance of the fund.
Very well, thank you. I have no further questions. Board Member Harper.
Thank you, Mr. Chairman. And Rendell, always good to see you here at the table. I know my question actually builds off a point that the chairman was making in his first question. If we could go to slide 16 in the appendix. Thank you. Rendell, I know that I've asked you a question like this before, but looking over time, at least back to 2006, this is the best performance, if you will, that we've seen for the system in terms of the distribution of assets and camels, at least within that timeline. Would you agree with that?
I do.
And have we actually gone back to look further back in time to see whether it's the best of all time?
Not very far beyond what's on the slide, but it is still a very good result and reflection of great performance and improvement in the system overall.
Great. Thank you very much. I'm done.
Okay, thank you. Board Member McWaters.
Thank you, Mr. Chair. Rendell, let's go back to slide 6, and I want to follow up on a very good question that the chair asked. You said that the 1.33 equity ratio was a timing difference, a timing of billing and collecting and recognition for accounting purposes and the like. But let's say that that recognition was reflected in here and it wasn't September, it was June. Would the equity ratio be around 1.38, the best you can tell?
It would.
Okay, thank you. Next page, slide 7, and also page 9. If you look, just draw a line from 2014, the 1.13, all the way to the 0.084, and then draw a line on slide 9 from 2014 to 2019. Camel 4 and 5s and 3s have dropped precipitously over the last, what is that, 6 years or so. Do you know what that's attributable? I mean, is the answer that we are merging out, or the credit unions that are in trouble, the 4 and 5s particularly, are simply they're smaller, they're being merged, and they just disappear, and that's the reason this is going away? Or is there something else?
So it's a bit more complicated than that. So these are snapshots in time of composites across the system. So changes are, sure, the result of mergers. They're the result of failures. They're the result of improvements or degradation in credit
Sure.
unions at that time. So it's really all of those reasons. And so in order to understand precisely, we'd have to look at the specific starting point compared to the specific end point, and we'd have specific number of credit unions associated with names of those credit unions as to who's improved, who's failed, who's merged out, and who's decreased.
Okay, thank you. That's all my questions.
Great. Thank you.
Thank you.
The second item on our agenda today is Final Interpretive Rule and Policy Statement 19-1, Exceptions for Employment Restrictions under Section 205D of the Federal Credit Union Act, which is also known as the Second Chance IRPS. Staff presenting this morning, Pamela Yu, Special Counsel to the General Counsel. Welcome and good morning.
Good morning, thank you. Today I'm presenting for the board's consideration Final Interpretive Ruling and Policy Statement 19-1 regarding exceptions to employment restrictions under Section 205D of the Federal Credit Union Act, or the so-called Second Chance IRPS. Section 205D of the Federal Credit Union Act prohibits, except with the prior written consent of the board, any person who has been convicted of any criminal offense involving dishonesty or breach of trust, or has entered into a pretrial diversion program in connection with prosecution for such offense, from participating in the conduct of the affairs of an insured credit union. Our current guidance on Section 205D, IRPS 08-1, was issued in 2008 to provide direction and guidance to federally insured credit unions and covered persons by describing the actions that are prohibited under the statute and establishing the procedures for applying for the board's consent. The current IRPS has not been revised in over a decade. Recognizing that certain offenses are so minor and occurred so far in the past as to not currently present a substantial risk to insured credit unions, IRPS 08-1 excludes certain de minimis offenses from the need to obtain consent from the board. However, several recent applications requesting the board's consent involved fairly minor, low risk, and isolated offenses that did not fall within the current de minimis exception. In light of these recent cases, the substantial passage of time since the current IRPS was adopted, and the agency's commitment to opening a redemptive path forward to productive living for persons with conviction records, the board determined the time was right to consider expanding the exceptions to the Section 205D employment restrictions. Therefore, in July, the board issued and sought public comment on a proposal to revise and update the IRPS to reduce regulatory burden and to expand employment opportunities for former offenders who have paid their debt to society. Deemed the Second Chance IRPS, the board proposed to amend the current de minimis exception to reduce the scope and number of offenses that would require an application for the board's consent to work. Specifically, the proposed Second Chance IRPS would not require an application for prior convictions for offenses involving insufficient funds checks of aggregate moderate value, small dollar simple theft, false identification, simple drug possession, and isolated minor offenses committed by covered persons as young adults. The board received a total of 12 comments on the proposed Second Chance IRPS. However, one of those comments represented 36 individual groups. The commenters generally supported the proposal. The general consensus among commenters was that the proposed guidance was well measured, balanced, and flexible, and will reduce burdens on credit unions, covered individuals, and the agency, while continuing to protect federally insured credit unions from the risks posed by convicted persons. Commenters widely supported the board's effort to expand employment opportunities for low-risk individuals with conviction histories and noted the second chance amendments are consistent with our nation's spirit of forgiveness. A few comments supported the proposal overall, but asked the board to go further to adopt additional reforms and improvements to promote opportunities for people with conviction records. On the other hand, a handful of comments favored narrowing the scope of the proposed exceptions and requiring board consent in more instances than proposed. Upon careful review of all the public comments, staff is recommending that the board adopt the second chance IRPS largely as proposed, with a few minor modifications for clarity and improvement. For example, we received feedback that the proposal's references to covered offenses involving an insured credit union or an insured depository institution was overly specific, as any prior conviction for a covered offense involving a financial institution, insured or not insured, can increase risks. Accordingly, the final second chance IRPS is revised throughout to eliminate the insured modifier. The final IRPS also makes clear that, consistent with applicable law, insured credit unions maintain discretion to establish internal employment policies and to make individual hiring decisions that best suit their own judgment. The final second chance IRPS will supersede and replace 08-1. In addition, to further improve and streamline the consent application process, staff recommends that the board adopt a delegation of authority to delegate to the regional directors authority to approve or disapprove credit union-sponsored applications to request consent. However, the board would retain authority to approve or disapprove individual applications, which provide for a blanket waiver for the applicant to be employed by or participate in any insured credit union, as those applications do tend to be more complex and fact-specific. I'm now happy to answer any questions.
Great. Thank you, Pamela. I am delighted to see the final guidance come before the board today, and I'd like to thank staff for their hard work on the second chance ARPS. As NCUA's chairman, my primary job is to protect the safety and soundness of the credit union system. But where appropriate, I also want to encourage the industry to take reform-minded steps to better meet the needs of the local communities that credit unions serve. The rule before us today does just that. Of the nearly 77 million Americans with some kind of criminal record, many of them pose little to no risk to society. They may have made a foolish mistake in their youth, but decades later, these Americans can still face hiring barriers that leave them underemployed with little to no access to economic mobility and shared prosperity. These individuals represent a significant potential economic resource, especially in today's tight labor market. But many have difficulty finding employment, even many years after paying their debt to society. Expanding career opportunities for those who have taken responsibility for past indiscretions is consistent with our nation's redemptive spirit. But it could also be an opportunity for credit unions. In the financial sector, there are, in fact, particular sensitivities. For instance, it would be difficult to make the case for a job applicant with a past financial crime that would undermine customer trust, like embezzlement, money laundering, or identity theft. However, when considering potential hires, an exemption may be warranted if the applicant poses no risk to the safety and soundness of the financial system. The rule before us today will provide regulatory relief by expanding the exceptions to the employment restrictions under Section 205D of the Federal Credit Union Act, thereby reducing the number of applications that will have to come before the NCUA board for our consent. Most of all, this is not only about regulatory relief, but also is simply the right thing to do. I am offering my full support of this final second chance rule before us today, but Pamela, I do have a few questions. In July, when we issued the proposed IRPS, I mentioned that some credit unions I had spoken to about this matter were strongly supportive of second chances, but expressed concerns this could increase the cost of fidelity bond coverage. Did we receive any industry feedback on this particular point?
We did, yes. The second chance IRPS maintains the agency's current policy to require that any person who meets a de minimis criteria must be covered by a fidelity bond to the same extent as other employees in similar positions. Several comments that provided input on this aspect of the proposal did express some degree of concern that increasing the number of accepted offenses could potentially lead to increased theft or fraud and then result in increased insurance costs to credit unions. But most of these commenters felt this was a fairly remote possibility, and in the short term, no immediate premium increases are likely to result. Comments from one insurer that provides fidelity bond coverage to credit unions was particularly helpful here. And they indicated that currently it's not anticipated that any immediate premium adjustments for credit unions would result from these amendments.
That's good to hear. Thank you. Another question is, the proposed IRPS asks for public comments on whether the board should delegate responsibility for reviewing certain applications for further streamline of the application process and to also reduce the burdens on credit unions and applicants. Can you tell us a bit more about the delegation of authority you're recommending the board adopt today, please?
Sure. Comments that we received were generally supportive of delegating authority to the regional directors in order to streamline the process. One comment letter actually suggested that the agency create a centralized office just to accept these types of applications. However, given the relatively small number of applications that we typically receive in a year, it's probably unnecessary to have one centralized office. However, as I mentioned, we are recommending the board have a delegation authority to delegate to the regions the authority to act upon credit union sponsored applications. But then the board would retain authority for the individual applications, which provide for a blanket consent and which also require the board's waiver of the institution filing requirement for substantial good cause. So because of those factors, I think it makes sense for the board to retain review of those types of applications.
Great, thank you. And I do have a final question regarding one of our peer regulators. The FDIC has a similar statutory prohibition in Section 19 of the FDIA, and the FDIC also provides for de minimis exceptions to their employment ban. Is the NCUA final IRPS consistent with the FDIC's policy?
It is generally. It's largely in line with the FDIC's Section 19 policy, and I think that maintaining consistency between the two is important and beneficial to both institutions and covered individuals, particularly because covered persons may wish to seek consent from both the NCUA and the FDIC for potential employment at either a bank or a credit union. Our guidance does go a bit further than the FDIC's guidance in that we've added an additional de minimis exception for single convictions of simple misdemeanor drug possession, which we believe poses minimal risk to insured credit unions. This should provide significant relief to certain covered individuals with drug convictions while still maintaining appropriate safeguards.
Great, thank you. I have no further questions. Board Member Harper.
Chairman Hood, thank you for advancing this second chance policy statement and for focusing our attention on giving people a chance at redemption. I will vote in support of finalizing the policy statement. And Pamela, thank you for your presentation today and your good work on the matter before us. As David Millar, the road racing cyclist who won several stages of the Tour de France and who was banned from the sport after taking performance-enhancing drugs, once said, people do make mistakes, and I think they should be punished, but they should be forgiven and given the opportunity for a second chance. We are human beings. In working to provide access to financial services to people of modest means, credit unions are very familiar with providing second chances. After all, they regularly work with their members who have experienced financial hardship and help to set them on the right footing. This policy statement will allow credit unions to do the same for their employees. That makes sense. After all, providing second chances is in credit unions' DNA. The NCUA Board, too, recognizes that many Americans face hiring barriers due to criminal records. Many of these individuals are not violent or career criminals. They are people who made poor choices and who have paid their debts to society. Notably, more than 70 million people in the United States have an arrest or conviction record that could show up in an employment background check. Many of these individuals are from communities of color, which have been disproportionately impacted by our criminal justice system. Giving these individuals a second chance is who we are as a nation, a people who value forgiveness and redemption. In that spirit of compassion, we are working to expand career opportunities for people who have demonstrated remorse and accepted responsibility for their past mistakes. we are also moving forward judiciously. As NASCUS noted in their comment letter, NCUA has taken a measured approach that balances mitigating risk to a federally insured credit union with providing a meaningful second chance to individuals who have committed a prior indiscretion, who have paid their debt to society and seek gainful employment. I very much agree. In particular, young people who took foolish missteps and committed minor offenses when they were still at an impressionable age should be afforded a greater opportunity for a second chance. To my fellow board members, thank you for including the ban the box language in this policy statement. Pamela, many states have adopted ban the box laws that prohibit employers from asking about criminal records at the start of the job application process. Would you speak to the prevalence of these laws and how our final policy statement would interact with these laws?
Sure. I understand that currently approximately 35 states have adopted these so-called ban the box or fair chance laws or policies, which are generally initiatives to delay background checks until later in the hiring process to ensure that job candidates can be duly considered without the stigma that can come with a conviction record. A dozen or more states also prohibit conviction history questions on the job application in the private sector. So these types of laws are gaining prevalence nationwide on both the state level as well as the federal level. For example, the EEOC also issued guidance in 2012 on consideration of arrest and conviction records in making employment decisions. Our final IRPS is consistent with the statutory mandate under Section 205D for insured credit unions to make reasonable inquiry regarding the history of every job applicant and to take appropriate steps to avoid hiring or permitting the participation of convicted persons. At the same time, our policy does not preclude credit unions from complying with ban the box laws if they're in a state where one has been adopted. Credit unions that are not subject to ban the box laws also have the option of adopting their own fair chance policies in their own internal hiring policies if they so choose. The IRPS provides that credit unions are responsible for establishing their own internal employment policies, and they have their own discretion to make hiring decisions consistent with applicable law. So an insured credit union can establish its own procedures to make conviction history inquiries at any stage of its choosing in its hiring process, just as long as applicants do not commence work for or be employed by the credit union before the applicant is determined to not be barred under Section 205D or receives the required board consent.
Thank you for that very informative answer, Pamela. Finally, in footnote 3 on page 4, we note that there are several recent cases where the offense in question met 4 of the 5 de minimis criteria but did not qualify for the exception because of the potential punishment exceeded the standard set in the 2008 policy statement. Would you provide some more detail about how this final policy statement would address this situation?
Sure. Yeah, so based on a historical sampling of our past consent orders, we saw that a number of the cases involve low-risk offenses like small dollar retail theft or shoplifting, and they often occurred when the offender was either a minor or a young adult. But because the policy requires consideration of the potential punishment, which in those cases exceeded the de minimis standard, the board's consent was required in order for those people to work for a credit union. Under the final IRPS, the amendments to the general de minimis criteria and the addition of new de minimis exception categories should help to reduce, and we approximate by as much as a third. It could reduce the number of these types of low-risk cases that need to come before the board for consent. In particular, I think that updating the general criteria for the de minimis exception to include covered offenses punishable by imprisonment for a term of 1 year or less, or a fine of $2,500 or less, or by 3 days or less of jail time will provide meaningful relief going forward. And then the new exception for small dollar simple theft of goods value at $500 or less should also eliminate many of the applications that in the past had to come before the board.
Great. Pamela, thank you again for those answers. I have no further questions, and as I stated earlier, I will support this final second chance policy statement.
Thank you. Board Member Brett Waters.
Thank you, Mr. Chairman. I agree with my colleagues. I agree with your statements and your inquiries. And I wish to thank you, Mr. Chairman, for bringing this to the board for our consideration. I very much support the rule You know, we live in a very puritanical society in a lot of respects where we institute, in effect, a financial death penalty on someone because of perhaps a youthful indiscretion, a foot fault that happened decades ago, and it's still haunting. It's hanging over people's heads, and they may want a job in a credit union or a bank. And I mean, who wouldn't? That seems like it's pretty good work. But we're saying no because of something you did when you were 17 or 27 or whatever. You can't do that. So we're condemning you. That small indiscretion, as I said, the foot fault is with you, an albatross around your neck for the rest of your life. Let's do something about that today. I have one question. Pam, how in this delegation of authority, how does that work? How will that be consistently applied from one region to another?
So the regions right now already kind of have the first bite at the apple with these applications. They already are submitted through the regions. So they are quite accustomed already to processing these applications. Of course, now they do their initial evaluation and then it comes before the board. So I think that the framework is already there for the regions to handle this delegation.
Okay, I just think it whatever's done needs to be consistently applied and applied within the spirit of this rule, which is second chances.
Yes.
Okay, thank you. That's all I have.
Thank you. And again, I want to thank my fellow board members for their support. The rulemaking today is now going to allow potentially 77 million hardworking people to have access to our regulated institutions. So I applaud that. And also to your point about the puritanical values and whatnot, you're right. These folks who have paid their debt and dues to society should no longer have to wear the scarlet letter. So I think this is really important. Since we all are supporting it, is there a motion so we can make it official?
I move that the board, one, approve the final interpretive ruling and policy statement 19-1 and adopt the delegation of authority SUP 49 as attached to the board action memorandum.
Is there a second to the motion?
Second.
There is a sufficient second. All in favor say aye.
Aye.
All opposed say nay. The ayes have it, and let the record show the motion passed 3-0. Thank you again, Pamela.
Thank you.
The third and last item on our agenda today is Proposed Rule Part 722, Real Estate Appraisals. Staff presenting Larry Fazio, Director, Office of Examination and Insurance, Kenneth Acuna, Senior Credit Specialist, and Rachel Ackman, Senior Staff Attorney, Office of the General Counsel. Yes, welcome and good morning, everyone.
Good morning, Chairman Hood, board members McWaters and Harper. I'm here with Staff Attorney Rachel Ackman and Senior Credit Specialist Kenneth Acuna to request the board approve a proposed rule to amend Part 722 of NCUA's Rules and Regulations. This proposal would increase the threshold below which appraisals are not required for residential real estate transactions, and the threshold increase would be from the current $250,000 to the proposed $400,000. We believe that the proposed increase is consistent with public policy interests, does not represent a threat to safety and soundness, and would reduce burden for credit unions and their borrowers. In fact, this proposal will restore the level of flexibility credit unions enjoyed when the threshold was last set in 2002, 17 years ago. The proposal also makes a couple of minor cohering amendments. Rachel is now going to discuss the legislative and regulatory timeline and history and some other legal considerations, and then Kenneth will discuss the various factors we considered that demonstrate that the increase in the threshold will not create a threat to safety and soundness.
In 1989, Congress passed the Financial Institution Reform, Recovery, and Enforcement Act, or FIREA. Title 11 of FIREA, as amended on various occasions as reflected on the above slide, directs each regulatory agency to prescribe uniform standards for real estate appraisals in connection with federally related transactions under its jurisdiction. Under FIREA, federally related transactions are defined as those real estate related financial transactions where an agency requires the services of an appraiser. However, each federal regulatory agency has some discretion to establish requirements for when an appraisal is necessary. FIREA also explicitly authorizes agencies to set threshold levels at which no appraisal is required. When establishing a threshold level below which an appraisal is not required, the NCUA must determine that the threshold does not present a threat to safety and soundness of credit unions and must receive concurrence from the CFPB that the proposed threshold provides reasonable protection for consumers who purchase 1 to 4 unit single-family residences. Following the enactment of Title 11 of FIREA in 1989, both the NCUA and the other banking agencies set their threshold level below which appraisals are not required for residential real estate transactions at $50,000. These levels were set in 1990. Over time, both the NCUA and the other banking agencies have increased the threshold level below which appraisals are not required for residential real estate transactions. The other banking agencies recently increased their threshold from $250,000 to $400,000, effective in October of this year. They had last adjusted their threshold in 1994. The NCUA's current threshold of $250,000 was set in 2002, 17 years ago. The NCUA is now proposing to increase the residential real estate threshold from $250,000 to $400,000. While we have not increased the residential threshold since 2002, in July of this year, the board updated certain aspects of the appraisal rule. In particular, the board enhanced independence requirements for individuals conducting written estimates of market value. By way of reminder, transactions below the residential appraisal threshold require either an appraisal or a written estimate of market value. A written estimate of market value must be conducted by an individual qualified and experienced to perform such estimate of value for the type and amount of credit being considered. Similar to the other banking agencies' residential appraisal final rule that went into effect in October 2019, for ease of reference, the proposed rule explicitly incorporates the existing statutory requirement for appraisal review. In addition, the proposed new $400,000 threshold would render the rural exemption in the Economic Growth, Regulatory Relief, and Consumer Protection Act, or S2155, moot. Therefore, the proposed rule removes the section covering the rural exemption. I will turn it over to Kenneth to discuss our analysis of the safety and soundness aspects of the proposed rule.
Thanks. In determining the level of the proposed increase, we modeled an approach used in the other banking agencies' rule process, and we considered a variety of home price and inflation indices to measure how prices have changed since 2002. So as we know, $250,000 in 2002 is not the same as $250,000 in 2019. In particular, we analyzed residential home prices based on the S&P's Case-Shiller Home Price Index and the FHFA Index, as well as the Bureau of Labor Statistics' Consumer Price Index. Okay, so when you adjust the 2002 $250,000 threshold based on these measures of inflation, the price in 2019 dollars would be approximately $360,000 to $450,000. The proposed threshold falls squarely within this range. The table at the bottom of the slide shows a comparable analysis for the other banking agencies who changed their threshold in 1994. The table below shows that $250,000 in 1994 would be worth somewhere between $420,000 and $660,000 today. In sum, this analysis shows that home prices have increased since the last threshold increase, and that $400,000 is a reasonable new threshold. Okay. This slide shows how real estate price inflation has affected the impact of the threshold over time. So in 1995, when the residential appraisal threshold was set at $100,000, 87% of credit union residential transactions were exempt from the appraisal requirements. By 2002, the level of exempt transactions had fallen down to 64%. The 2002 threshold increase to $250,000 reset this level of exempt credit union transactions at 95%. Since 2002, inflation and other factors have, again, led to the level of exempt transactions falling, now approximately only 77%. The proposed increase would restore the level of exempt transactions to approximately 95%. Okay. This slide is similar to the previous slide, but the focus here is on the dollar volume of residential transactions that are exempt. So here we see a similar trend, but the decline over time is even greater. Since the first threshold increase to $100,000 in 1995 exempted 85% of the dollar volume, the subsequent threshold increase to $250,000 and the proposed $400,000 each will result and have resulted in levels in the low to mid 80% range. We ran a similar analysis focusing on transactions in rural areas, and it indicates that rural transactions will benefit at levels proportionate to these overall levels in terms of both dollar volume and number of transactions. I'd also note that the number of transactions and dollar volume of residential transactions would be exempt for credit unions is higher than for banks, even though the proposed $400,000 is the same as their new threshold. This is because credit unions tend to make smaller dollar volume loans and in the residential real estate space. Okay, so in the next two slides, I'll walk you through the performance of residential real estate for credit unions and banks through economic cycles and previous threshold changes. So we examined call report data and determined that credit union residential real estate secured loans have performed well with relatively low delinquencies and net charge-off rates. Okay. So as seen in the graph above here, we did not experience an uptick in delinquencies following the 1995 and 2002 threshold increases. But more importantly, following the aftermath of the great financial recession of 2007, credit unions experienced modest levels of delinquencies relative to FDIC-insured institutions. And we believe this is a testament to credit unions' mission of serving their members and the fact credit unions know their customers. Okay. So this chart shows net charge-off rates. So we looked at them from 1994 to 2018, which includes two recessionary periods similar to the previous slide. And the data reflects that losses associated with residential real estate loans and credit unions has been relatively modest. The net charge-off rate for residential real estate transactions did not increase after the NCUA's increase in the appraisal threshold from 50 to 100,000 in 1995, or when NCUA threshold was increased to 250,000 in 2002. And again, during the great financial crisis, credit unions experienced much lower levels of charge-offs compared to FDIC-insured institutions. Okay, so we estimate that the increase in the threshold would incrementally exempt less than 1% of credit union system assets. And as shown on this slide, credit unions originated approximately 78% of the first mortgages in 2018, first mortgage assets in 2018. Under the current rule, about 18 billion of these are exempt from appraisal requirements because they are sold to Fannie and Freddie Mac. And this is reflected in the red bar, number 1 on the chart here. So another $11 billion of transactions were granted under other government guaranteed programs and therefore are largely exempt as well. And this is shown in the yellow chart. So as you go down, the green bar shows that another $27 billion in transactions are exempt because they are below the current $250,000 threshold. And finally, the blue bar shows that about $8 billion of originated residential real estate transactions would remain subject to appraisal requirements. So therefore, the proposed rule would only exempt an additional $14 billion of residential real estate transactions per year from our appraisal requirements, or 46,000 transactions based on the 2018 levels. This equates to less than 1% of credit union assets as of the June 2019 call report. So relative to credit union system assets, the incremental level of real estate transactions exempt from appraisals would not threaten the level of safety and soundness. Okay, so finally, we would like to reiterate that credit unions would continue to be required to obtain written estimates of market value for transactions under $400,000. A written estimate of market value prepared by qualified and experienced individuals generally provides sufficient information to enable credit unions to make credit decisions. Through the interagency guidelines, the NCUA has provided guidance on its expectations regarding when and how written estimates of market value should be used that are consistent with safety and soundness practices. The guidelines state that a written estimate of market value should provide an estimate of the property's market value and have sufficient information and analysis to support the credit decision. The guidelines also describe the content that an evaluation should contain. So furthermore, as is the current practice, credit unions and borrowers may attain appraisals to establish collateral value even if a transaction is exempt from the appraisal requirement. The guidelines advise credit unions to develop policies and procedures for identifying instances where this would be prudent. The NCUA also retains the ability to require an appraisal whenever necessary to address safety and soundness concerns. Credit unions have often had similar standards where they require appraisals based on determination of risk in a given transaction. And we believe that written estimates of market value do provide a proven, safe and sound alternative for transactions below the applicable thresholds. We continue to evaluate the use of written estimates of market value as part of the examination and supervision programs. Okay. So on the following slide, public comment. So this concludes the presentation, but we want to note that the notice for the proposed rule encourages stakeholders to comment on all aspects of the proposed regulation, especially in regards to consumer protection and safety and soundness. The preamble contains several specific questions. Those questions can be summarized into the following categories: burden relief, current use of written estimates, usefulness of publicly available information on property valuation, and any other information that the public wishes be considered in this rulemaking process. So to conclude, we request the board approval to publish this notice for proposed rulemaking in the Federal Register for a 60-day comment period. We would be happy to take any questions that you have at this time.
Great. Well, first of all, I want to thank you all for your presentation this morning. And Kenneth, I want to thank you for working through the audio difficulty with such a plum. I know that would have been difficult to carry on, but that you did, so it's greatly appreciated. Also want to thank your team, you all, for the hard work that went into this proposal. Since I assumed the chairmanship at the NCUA over 7 months ago, I've made reforming outdated regulations a top priority. This rule continues our updates to the NCUA's appraisal regulation and, like the other federal banking agencies, proposes to increase the appraisal threshold for residential transactions from $250,000 to $400,000. As with the other regulatory reforms, this was not an easy issue. This was not something that we approached lightly. We carefully studied market conditions, assessed industry norms, and consulted with stakeholders to determine the appropriate way to proceed. The due diligence meant that we could move forward with confidence that this reform would not compromise the safety and soundness of the credit union industry or the share insurance fund. Credit unions, by and large, prudently underwrite residential real estate loans. They typically use secondary market underwriting standards set by the government-sponsored enterprises. Thus, credit union lenders may continue to require appraisals on properties valued below the proposed new $400,000 threshold at their own discretion. But I would like to note, if this rule becomes final, credit unions will still be expected, as always, to wisely manage risk in their loan portfolios and to ensure they continue to follow appropriate lending practices. In fact, credit unions are already well known for their prudent approach to underwriting residential real estate loans, as evidenced by your slide, Kenneth, on slide 9. Many credit union residential mortgage loans are made under federal or state guarantee programs like the Federal Housing Administration, Department of Veterans Affairs, Rural Housing Service at USDA, or Farm Service Agency. Loans issued under these programs are already largely exempt from the NCUA's appraisal requirements. Thus, the proposed threshold increase will not even be applicable to a portion of credit union mortgage assets. This appraisal threshold was last raised in 2002, but in the ensuing 17 years, the housing market has experienced increased demand, tight supplies, and increasing home values. This rule does not undermine consumer protection. The CFPB, the agency primarily charged with consumer protection, has approved the $400,000 residential real estate appraisal threshold recently finalized by the other banking agencies. This is a reasonable, common sense adjustment that will benefit both lenders and borrowers by lowering costs and reducing the time needed to complete residential lending transactions. I now have a few questions. Many borrowers rely on appraisals as an important way to value their home purchases. Does the proposed rule sacrifice this important consumer protection benefit?
So we believe that the written estimate of market value is a comparable tool, and it has some of the independent standards for the person conducting the transaction estimate, and to verify that they have the right experience to handle that.
And I think I would just emphasize too that cranes will often continue to still get appraisals, and that the consumer also has the borrower has the opportunity to request an appraisal as well.
Got it. The proposed rule exempts more credit union transactions than the banking agency's similar final rule. Can one of you please explain this for the record?
Sure, I'll take that. So as you mentioned, this rule exempts more transactions for credit unions as the FDIC's rule for the same threshold. And this is because generally credit union transactions are a lot smaller. So we did some additional digging and compared the two numbers, and we find that this is a testament to how credit unions serve their members, especially those of modest means, so the overall smaller level of transaction.
Great. Thank you. And I just have one final question. You also mentioned rural areas. Would this rule benefit credit unions helping members get mortgages in rural areas or underserved populations?
Yes, it will. As Kenneth had noted, the statistics we show for the whole group of credit union system lending also apply to rural areas. So we would expect to see that level of flexibility also be prevalent in rural areas. Because of the increase to the threshold to 400,000, it also simplifies improves the flexibility by simplifying what had been the rural exemption in S2155 that Rachel had talked about. That required some additional steps the credit union to go through before they could waive, so to speak, the appraisal requirement. This just simplifies it at 400,000, and so it would facilitate lending in rural areas as well.
Great. I have no other questions, but again, I'd like to thank all of you and your team for your hard work. Board Member Harper.
Thank you, Chairman Hood, and thank you, Rachel, Larry, and Kenneth for your informative presentations. I must admit that I approached this proposed rule with some real skepticism and genuine doubt. While the goals of targeted regulatory relief and greater uniformity among regulators are desirable, we also must ensure that any rule change protects the safety and soundness of individual credit unions and the entire system, as well as provides consumer protection. In other words, we should take measured steps to ensure that we aren't just jumping over a cliff. If we finalize the threshold as proposed, 94% of residential mortgages underwritten by insured credit unions would be eligible for the appraisal exemption. In comparison, only 72% of mortgages by insured banks and thrifts are eligible for a written estimate of market value instead of an appraisal. Thus, the proportion of residential loans exempted is significantly higher in the credit union system. Additionally, we now have experienced an economic expansion that has lasted more than a decade, the longest in history. Because we will eventually experience an economic downturn, and because that downturn seems likely to occur sooner rather than later, I have apprehensions that we may be loosening regulatory standards at the wrong point in time in the economic cycle. While the proposed rule before us may produce some consumer benefits, there are also downsides we need to consider and other actions that we could take that would be more meaningful. Obtaining an estimate of a property's worth is a key part of the mortgage underwriting process. Typically, because of federal regulations or the securitization eligibility standards imposed by Fannie Mae and Freddie Mac, lenders obtain an appraisal to determine the value of the collateral for a mortgage. An appraisal helps to verify a property's value for the buyer, seller, lender, investor, and others. To provide this assurance, Congress recognized in the Dodd-Frank, Wall Street Reform, and Consumer Protection Act that appraisers must operate as unbiased arbiters. The statute, therefore, strengthened independent standards and increased sanctions for violating such standards. The law also improved federal oversight over the appraisal industry. I am concerned that the proposed rule we are considering today could negatively affect the progress we've made in both of those areas. Additionally, written estimates of market value are less regulated than appraisals. Under this proposed rule, written estimates of market value may be completed within the credit union. Therefore, an imprudent lender may take actions to increase loan volume by decreasing quality control standards, as was the case during the last financial crisis. After all, we know that if you give opioid addicts prescription pads, there is a greater likelihood that they will write their own prescriptions to feed their bad habits. Accordingly, I have three initial questions for staff. First, I would like to know what requirements are in place to ensure that individuals preparing written estimates of market value are qualified, competent, and independent of the loan production function within a credit union.
I'll take that one.
Thanks,
Those
Rachel.
are all expressly included in the regulation. Written estimates of market value, the people performing them, they have to be qualified, competent, and independent of the loan production and collection process.
And how are we going to ensure that? In other words, how are we going to, do we have the power to take action if credit unions do not follow these requirements?
We do. Because they're regulatory requirements, we could act on potential violations. In the regional offices, they could do informal or formal enforcement actions if there are any violations.
Okay. And what paths will consumers who may be affected by a faulty written estimate of market value have to complain and seek restitution?
They can use the NCUA's complaint process. The CFPB also has a complaint process that they can avail themselves of. And because they are regulatory requirements, the NCUA can do a restitution order as well as an enforcement action.
Another long-standing concern that I have relates to automated valuation models, or AVMs. As I understand, the estimates produced by AVMs may be used in developing a written estimate of market value. Is that correct?
They can be used as part of
It's
a written
not,
estimate.
yeah.
Yeah, it would be one factor. An individual has to look at the written estimate and decide on their own if that is an appropriate valuation.
Congress recognized that there were problems in AVMs, and recently I experienced the problem firsthand when buying a new home. Within a month of purchasing the house with my partner, I received an unsolicited estimate produced by a widely known company that uses AVMs. Under this estimate, our property had gained more than 10% in value, even though we had made no improvements. The housing market in Arlington may be hot, but it's not that hot. My personal experience demonstrates the shortcomings of AVMs. To enhance confidence in the results produced by automated valuation models, as part of the Dodd-Frank Act, Congress added a new requirement to federal appraisal rules to ensure that AVMs adhere to quality control standards designed to ensure a high level of confidence in the estimates produced. To implement those standards, the law required the NCUA, the federal banking agencies, and the appraisal subcommittee to develop rules. The altering of the appraisal threshold for federally related transactions is a discretionary action, but the AVM rulemaking was mandatory. More than 9 years have passed since the Dodd-Frank Act became law. In my view, it is long past time for regulators to complete their work on the AVM rulemaking. In voting for this proposal today, I am hoping, therefore, that we will see positive momentum on the AVM rulemaking in the near future because it is interconnected to the proposed rule before us. Additionally, the rule before us may provide some consumer benefits in terms of cost savings, but an even greater benefit to consumers would occur if we adopted a rule on appraisal report portability. An appraisal portability regulation would allow consumers to shop for rates with lenders by using just one appraisal instead of ordering a separate appraisal with each lender. Shopping for rates using one appraisal could lower mortgage costs over the long term and result in substantial savings for consumers. The Dodd-Frank amended the Truth in Lending Act to allow regulators to develop an appraisal report portability rule. However, regulators, including the NCUA, have yet to act on this discretionary power. In voting for this proposed rule today, I'm also hoping that we might take action on this long dormant policy matter. Before I close, I do have a few more questions for staff. First, the Dodd-Frank Act put in place prohibitions on the use of broker price opinion as the primary basis to determine the value of a consumer's principal dwelling. Will this prohibition remain in place if this appraisal threshold rule is finalized as proposed?
That's a statutory prohibition, and this rule doesn't affect that. It's still effective.
Thank you, Rachel. Second, credit union loans are increasingly concentrated in real estate. In 2002, when the residential appraisal threshold was last updated, just under 43% of federally insured credit union loans were in real estate. In 2019, that figure grew to nearly 50%. This increase in concentration in this system might lead to problems if the proposed rule moves forward. As such, I would like to know whether we plan to conduct a more detailed economic analysis of this proposal on the safety and soundness of the credit union system and individual credit unions before considering a final rule.
So we're obviously going to get comments on this rule if the board approves it, and I'm sure we'll get a lot of input from stakeholders on different ways to think about safety and soundness and the other policy considerations. We will be evaluating those as part of the rulemaking process, and I'm sure we'll continue our research and analysis as we go through that process, and we bring to the extent we bring a final rule to the board.
And you'll be working with our chief economist's office in order to make that happen.
Yeah, we work with typically work with the chief economist's office on rules that involve analysis. Yeah.
Okay, thank you. Finally, the preamble of the proposed rule notes that if a credit union decides to obtain a written evaluation of market value instead of an appraisal, a borrower may still choose to obtain an appraisal before closing the transaction. At what point in the process would a consumer learn that piece of information? Would it be disclosed as the underwriting process begins or at the closing table? One would give the consumer time to act, get an appraisal if they want before closing the loan, and the other would not.
I can answer that one. It would be at the beginning of the process. I believe after the application for the loan, the credit union has 3 days to provide an estimate of the fees.
And with that estimate of the fees now say that you have the right to obtain an appraisal if one is not being provided?
I think it would include whether you have an appraisal, and I don't think I believe for higher price mortgages doesn't include an express you have a right to obtain a mortgage. It's my understanding.
For higher price mortgages, it would certainly, there is a statutory requirement that they get appraisal, so I'm not so sure that's the case.
So that may be correct. There's a requirement to get an appraisal. I think they have an obligation to make an affirmative that you can also get one on your own as the consumer. I don't think that exists, if I'm understanding it correctly, for non-higher price mortgages.
I see what you're saying.
Okay.
And my point here is that consumer awareness and for the consumer to take action if they want to take the steps to get an appraisal. They ought to have a clear disclosure early in the process so that they're not caught unaware at the closing table that the property wasn't appraised. And I think that that's something we can continue to talk about and work on. Again, thank you for your helpful answers to all three of you. Although I still have concerns about this matter, I will vote for the proposed rule to move the process forward with the expectations that we will work to address my other concerns before considering a final rule on increasing appraisal thresholds.
Great, thank you. Board Member McWaters.
Thank you, Mr. Chairman. Let's go to slide 6, please. So if I'm reading this slide correctly, if it's 2002 and the NCUA adopts an appraisal rule and the appraisal rule sets $250,000, but it says it's indexed to the Case-Shiller index, which at the bottom of the page says it tracks the value of single-family housing in the United States. So it's an inflation adjustment based upon a specific asset in that single-family housing. So today, if I'm reading this correctly, second quarter 2019, the appraisal rule would automatically be set at $455,000, meaning anything below $455,000, no appraisal. Anything above $455,000, appraisal is required. Is that a correct reading?
So the way I look at this is if you took out a home loan in 2002 and it was $250,000 or under, so we were appropriately, we thought that was an accurate and modest or reasonable level. If you had that same loan and traveled it through time and now you're taking out the same loan, that loan would be worth about $450,000 or so. So because we were comfortable with that level in the past, we're showing that really if nothing has changed just because of the way prices have increased, that's that same level. So just kind of translating those dollar values through time.
Okay, I think I get that, but I think you're answering my question by saying yes.
Mm-hmm.
Okay,
Yeah.
I mean,
Yeah.
is that, I mean, I don't mean to be flippant about that. I just want to make sure there's no confusion about that. So if we marked the rule back in 02 to FHFA or to Case-Shiller, we would already automatically have an appraisal rule on the books at above $400,000. Right. If we marked it at CPI, which, doesn't track house prices like Case-Shiller and FHFA, we would be at 361, so we'd be about 39,000 below the 400. Okay. So this is not a radical change just based upon asset inflation, particularly asset inflation for single-family homes. So let's talk about appraisals for a second. There seems to be this confusion by some, and I've experienced it over the years, that appraisals are somehow a holy grail. They're somehow a guarantee. They're not a guarantee. They're a point-in-time estimate. An appraiser signs something that says, I appraise the value of this home or whatever to be a certain amount. And those appraisals for residential real estate, at least urban residential real estate, they're based upon comparable sales. So the appraiser looks at the house you want to buy. They look at the neighborhood. They look at comps. They look at square footage. They look at the condition of the house and all that, and they base the appraisal on that. So in effect, a modern residential real estate appraisal in an urban area is a mark to market. So if we go back to 2005, we had a real estate bubble that was building. A lot of people didn't think that. If they did, then we wouldn't have had 2008, right? So the bubble was building, and if we had had an appraisal rule, and let's say the appraisal rule was 0, where every house transaction required an appraisal, then the appraiser would go out and look at comparables in urban areas and say, oh gosh, the house prices are going up. They're all third-party transactions between a willing buyer, a willing seller, and a willing lender, okay? Nobody has a gun to their head. There's no pressure. And so I'm going to give an appraisal based upon that. And you know what? If I don't give that appraisal, what happens to me? Am I going to get a lot of business? No. I have to mark to market. That's what appraisers do. Now, my question is this, Mr. Fazio, given that rather cynical view of this, that appraisals are not guarantees, they're point-in-time estimates based upon comparables, and the comparables may be in a bubble like we were in 2005. How, from the NCUA's perspective, from a safety and soundness in examining credit unions, supervising credit unions, do we deal with that uncertainty? Because we can't be so naive as to think, oh, there's an appraisal on the books, therefore those homes, that portfolio of homes is going to be good at that value. Again, point-in-time estimate. How do we deal with the safety and soundness issue?
Well, first it comes back to underwriting. The value of the estimated value of the home, that point in time estimate, isn't the dispositive factor in granting the loan. First of all, that's part of why you have loan to value requirements that are generally less than 100% if you're doing prudent lending, to account for that risk of inaccuracy in the value as well as future changes in the value. You're also looking at ability to repay. The ability to service the debt. In the consumer residential context, you're looking at their income, their disposable income, and how much of that's going to service that mortgage. And if they have good job security and they have good income and the low debt to income ratio, they have a very strong ability to repay, and they're not as dependent on the collateral value in the case of a default, because they're not expecting that borrower to default. So, and that's just a couple of examples of the panoply of things that go into underwriting, and that's the decision of whether or not to grant the loan. And of course, we're examining credit unions to make sure they are approaching all of their lending, in particular residential real estate lending, that they're approaching it prudently, and we will continue to do that.
Okay, thank you. So what you're saying then is that looking to an appraisal, looking to the value of the home is really almost a secondary source of repayment. Homes, private residences don't generate income. In fact, they're really net loss because you have to pay property taxes, you have to insure it, you have to cut the grass or whatever. So that's a negative cash flow there. But the positive cash flow that allows the mortgage to be served is really the ability to repay. Does the borrower have a job? What's their job history? Things like that. So I think that we can put a little too much emphasis on appraisals, thinking that, if we have them, everything is going to be okay. And it's really a fallback situation. And chances are, if we enter into a recession, and it's a tough recession, then the housing prices will drop because people will lose jobs, they will have less cash flow and less ability to purchase a house. So I will support the rule. I think it's a prudent thing to do if for no other reason because of what's on slide 6. But I think we have to walk into this and not pat ourselves in the back and say everything's okay because there's an appraisal in the file. Thank you.
Great, thank you. Is there a motion?
Yes. I move that the board approve proposed rule part 722 of NCUA's rules and regulations for a 60-day comment period as attached to the board action memorandum.
Is there a second to the motion?
Second.
There is a sufficient second. All in favor say aye.
Aye.
All opposed say nay. The ayes have it, and let the record show the motion passed 3-0. You all, thank you. This does, in fact, conclude our board meeting today. I just wish you all and your families a happy Thanksgiving, and we look forward to seeing you hopefully at the December board meeting. Thank you. The meeting's adjourned.